One of the first auditing scandals that we're going to take a look at is Enron. Enron was one of the largest American energy companies during its time, and it's also important to note that its bankruptcy and downfall in 2001 was one of the main reasons for the adoption of the Sarbanes-Oxley Act in 2002. The scandal began when Enron was to continue to project that it was high performing when it wasn't performing as successfully as it had in the past. And to cover up the poor financial position, management began adopting these complex financial journal entries that it used to create its financial statements. Top executives were also responsible for carrying out majority of the acts to compromise this scandal. And one of the things that they did, they misled the board of directors and the audit committees on much of the financial statements because the only ones who actually understood what was going on. Also, top management pressured Arthur Andersen to ignore these issues, and the fact that Arthur Andersen actually did ignore these issues was one of the main reasons for their dissolution in the end. The biggest losers ended up being the shareholders who lost billions of dollars. The Enron's price of their stock went from a high of $90 per share, plummeting all the way down to $1 per share. We're now going to take a look at the Tyco International scandal, and this scandal paints a big picture of what greed looks like. Former CFO Mark Schwartz and former CEO Dennis Kozlowski had reportedly stole over $150 million from the company. The external auditors for Tyco International at the time was PricewaterhouseCoopers, and the engagement that PwC had with Tyco brought in millions of dollars in revenue for the auditing firm. At the end of the scandal, PwC was charged for violations in independence, and as we can take note, it seems that a lot of lines are blurred with independence as the amount of money for engagements rises. The last auditing scandal that we're going to take a look at is WorldCom. WorldCom saw many early successes in adopting a new business strategy by their former CEO, Bernie Ebbers. This business strategy relied on major growth through major acquisitions. When peak of the growth was reached and no feasible acquisitions were available, management took two complex, tricky financial schemes to portray continued growth and success. In essence, they were basically trying to keep up with their past. This fraud was first uncovered by the Internal Audit Committee of WorldCom, but by the time they had uncovered these frauds, there had already been billions of dollars stolen from the company. The external auditors, we might know, were also Arthur Andersen, when during this time they had already were under investigation about the scandals that happened in Enron. We would like to point out a lot of the implications that we were able to draw from these scandals. One was there is an overwhelming trust that the public puts in the accounting professions. And with that, we mean that the accountants and the auditors have the knowledge and the expertise of what is going behind these financial statements. And with that knowledge and expertise gives auditors the power to deceive the public. Also, the board of directors, the internal audit committees, and even worse, the shareholders, who usually don't even have the basic common knowledge to understand many financial statements and figures. Second, there is a growing lack of independence between audit firms and their clients. And with this, you can see that auditors are not acting in the interest of the public, which is the biggest issue. The long client and audit relationships that are becoming too personal and not strictly professional tend to have the reaction of those auditors acting in self-interest or only acting in the interest of their clients and not for the public who they should be acting for. Also, thirdly, the auditors are failing to accept responsibility. Auditing firms tend to feel like they're being attacked, and they're only being attacked because they have larger pockets to pay those people who were hurt by these frauds. And since the people who committed the frauds go bankrupt, the next people to look at are the auditors and the auditing firms who actually have the money. Another thing with auditors being able to fail to accept their responsibility, instead of changing their behaviors, a lot of auditing firms are going to legislation and trying to have a change in their lobby to influence changes in standards instead of actually changing their behaviors, which change in behavior is what we need to see.
Independence could be defined as freedom from those pressures and other factors that compromise or can reasonably be expected to compromise an auditor's ability to make unbiased audit decisions. The reason why most conflicts arise is due to the structure of public accounting. Client pays whereas public relies on the work of the auditor. The relationship that auditors develop with their clients may cause them to favor clients and not work for the best interests of the public or accounting profession. The longer the auditor spends working with the client, the stronger the relationship gets, making them more empathetic with the client and therefore jeopardizing their independence. Higher audit fees tend to test the independence and character of auditors. The higher the economic incentive of keeping a client, the greater the probability that auditors will compromise their objectivity and independence. The quantity of client size in relation to other clients and amount of audit fee strongly influence auditors' decisions as well.
There are many factors that lead auditors to give inaccurately favorable audit opinions. The most obvious is that firms want to keep their clients happy, so they will continue to employ the audit firm. Auditors may also fear losing their jobs if they are responsible for losing a large client. There are also several non-monetary factors that would entice auditors to give favorable audit reports in favor of their clients. One being that auditors do not really know who will be affected by giving an inaccurate audit opinion, but they know the people at the company that will be affected if they issue an accurate negative opinion. Additionally, the effects of issuing a negative audit opinion are immediate, while the effects of providing an inaccurate audit opinion may not be clearly seen by the auditor at first, or even at all.
Research findings show if auditors believe the payoff from keeping the client would be greater than getting caught and facing litigation, fines, and embarrassment, they would take the client's side. When there is strict monitoring and severe penalizations to be handed out, independence violations seen among auditors are greatly reduced. Also interestingly, it was found that auditors are more receptive to positive economic payoffs than penalties and loss from punishments. People who had higher innate moral development did not need negative consequences to induce them to make the right decision. Conversely, those with lower moral maturity would tend to take into the effect the cost-benefit analysis to guide their decision-making.
Another problem arises from having too much independence. After the government forced Arthur Andersen into bankruptcy, the remaining members of the Big Five feared the same punishment for future misconducts. As a result, the Big Four changed their partnership structure. Now each branch of the Big Four companies is its own limited liability partnership. This means that the firms as a whole cannot be held responsible for the actions of one single branch or one partner at individual branch. By doing this, the Big Four severely limits the government's ability to punish the entire auditing firm for the misconduct of a few partners. As a direct result, there is less of a deterrent for large accounting firms to follow accounting regulations. Independence can be a bad thing when auditing firms act in their own best interest and not in the best interest of the public. This conflict of interest arises when auditing firms are also allowed to provide management consulting services to the same companies that they are auditing. As a result of this conflict, auditing firms may be monetarily motivated to find more problems and violations with their clients than actually exist. This could result in clients paying for consulting services that they don't actually need. This was a very large problem in the United States prior to the passing of the Sarbanes-Oxley Act in 2002. In essence, the auditing divisions of firms were not motivated by issuing an accurate audit opinion, but rather by generating business for their consulting divisions. Now, auditing firms cannot provide consulting services to the same companies that they are auditing. The competitiveness of the auditing market has the largest effect.
Audit firms use strict time budgets, therefore in some cases the quality of audit engagement is reduced. This in turn makes the auditor susceptible to pass off evidence, work, and investigations of insufficient quality. Promotions within an accounting firm are not based on considerations of the ethical duties of the accountant and auditor. This in turn creates a rift with the whole idea of professional accountancy, as it focuses on ethics to a large extent. Accounting firms have the ability to mold an employee's moral compass. In Schlachter's opinion, disregard of ethical standards jeopardizes career opportunities, while a reputation for high ethical behavior does not enhance advancement. Firm culture does not cultivate seeds of morality within an employee. Audit managers are rewarded by partners for completing an audit within the budgeted time. Research shows as you progress through the ranks within an accounting firm, your morality will decrease. Partners have the lowest level of cognitive moral development among the firm's employees. Kohlberg is used to measure one's moral maturity and consists of 3 levels of moral development: pre-conventional, conventional, and post-conventional. Each level consists of 2 stages. The goal is to reach the post-conventional stage. Academic studies show auditors are at lower levels of moral development than auditing students. Within professionals, audit managers have the highest levels. Women professionals have higher stages of moral development than men. Partners exhibit lower moral development than junior employees. It means adherence to GAAP and generally accepted auditing standards does not promote progression of auditors' moral reasoning to the desirable level 6. Practitioners do abide by the code of ethics promulgated by the accounting boards and societies, and by doing that they feel they are doing more than enough and do not wish to reach for the post-conventional level. Auditors operate at conventional levels of moral reasoning and will solve ethical dilemmas by looking to guidance from the rule book, motivated by the desire to maintain social order and by a respect of authority.
Within the auditing profession, there are several things that provide conflict with the auditor and their ethical duties to the public. Things like political motivations, extrinsic motivations, and self-interest. According to Ethical Issues in Accounting, in any significant world economies like the United States, auditing is a business and the auditors act in a way that increases profit. Profit is a clear extrinsic conflict for auditors because it makes them act in a way that is not in the interest of the public, but in their own interest. The corporations are the ones that contract with the accounting firms to have them audit their business, so they are the ones footing the bill, not the public. This makes it much more tempting for the auditor to act in a way that may not satisfy the public, but the corporations. Such self-interested egotistical behavior allows the auditor to ignore any other considerations and act in an unethical way. Another extrinsic conflict of interest that an auditor may easily face includes impossible constraints. These are put on them by the audit firm and can result in monetary motivators. One good example is the time constraints that are put on audits that are almost impossible to meet, but if they are met, there are possibilities of promotions or bonuses. This fuels an environment where auditors are willing to misstate certain numbers or skip certain testing procedures to receive these extrinsic rewards. These extrinsic and monetary conflicts of interest give rise to a lobbying culture in the audit profession. This in turn directly conflicts with the auditor's duty to the public. What happens is if an auditor or a firm does not like a certain legislation that is being passed by Congress or the PCAOB, then they will send large amounts of money or their general support to those people involved in these organizations so their agendas are passed. A good example of this is in 2002, after the Enron scandal, Arthur Levitt Jr., chairman of the SEC, sought to prohibit all accounting firms from performing both audit and consulting functions for the same firm. This bill would have caused the Big Five, Anderson included at the time, to lose a significant amount of revenue from the consulting function. Therefore, accounting firms started lobbying intensely, sending countless amounts of money to stop the bill from being passed. Although this resulted in SOX 2002 being passed, it was one of the first time lobbying was used so heavily by the firm. An increasing lobbying culture has only continued since the Enron scandal. In 2004, there was a sharp decline from Deloitte's lobbying, but it only increased up until 2012. And in 2011, altogether the Big Four spent $9.4 million on in-house and outside lobbying. The firms also have a pull in the presidential races. The Big Five were in the top 20 for contributors to the 2000 Bush campaign, and his interests clearly aligned better with theirs than Al Gore's. And in 2012, the contributors to the presidential candidates reached $2,551,839, most of them going to Mitt Romney, who also would have supported their agenda. Congressional lobbying also occurs with political action committees funded mainly by the accounting firm's employees. Employees are directing the money towards Senate and House members that have direct influence over the industry so that their agendas are carried out. Another good example is Republican Representative Spencer Baucus, also chairman of the House Financial Service Committee, which in turn oversees the PCAOB. He has accepted at least $370,000 from the Big Four during his career, and he is an obvious opponent to the audit firm rotation bill. Seems like a clear conflict of interest towards the public, since audit firms are sending money to a man that has so much power in the PCAOB. So why are they lobbying? A lot of this money goes towards bills that deal with independence within the profession. One of the main legislations that is causing a big issue with accounting firms right now is the audit firm rotation bill. This would make it so corporations using the auditing service would need to switch their auditor after a stated period of time. This bill clearly supports the idea of more independence between the client and the auditor, because an auditor wouldn't be there long enough to form a relationship with the management of that company. The bill is also meant to increase the skepticism the auditor will use when looking at the new financials. Just like the previous bill in 2002, accounting firms would see huge decreases in profit from the losses of clients. Due to this, accounting firms have sent countless letters, 620 that have been received, to the PCAOB to try to stop the bill from being passed. For an auditor to have increased independence, this would increase their likelihood to act in the interest of the public instead of the corporations. There is no relationship with the managers of the corporation and the auditor. They may not be so persuaded by them to act in a way that doesn't support the public interest or is just plain unethical. Again though, since the corporations are paying the bill, they don't want an increase in independence because this may jeopardize their profit earned from the corporations. And in the end, the firms spend lots of money and effort to make sure such legislations do not get passed. On the other hand, the PCAOB and Congress should not be allowed to be persuaded by the firms. They should realize that the audit profession is one for the public, and those are the only people who should have any influence on rules and regulations within the industry. In the end, though, the accounting firms are the ones with the large amounts of money and the power to be able to impact legislation.
Looking back at Enron, we discover special purpose entities which were reported and disclosed on balance sheets as per the GAAP requirements. However, since they were so complicated in nature, most of the public were naive about them and did not know about the depth of SPEs. So the question becomes, would an auditor go the extra mile to protect or better serve the public? Research shows AICPA code is insufficient to motivate accountants to pursue ethical behavior. The idea that having a comprehensive set of rules would make an auditor more ethical is incorrect.
So our conclusion for ethical issues in the auditor is that based off of never-ending scandals, ever-increasing efforts of accounting firms to influence legislation, there are obviously ethical dilemmas within the audit profession. It seems auditors are losing focus on independence and their duty to the public. The profession is being considered as a business with the objective of making profits. In the end, for anything to ever change within the profession, many different ethical schools of thought need to be taken into consideration in determining codes and legislation on these complex ethical situations.